to get to our first corporate conversation on the show. And the company we're looking at is HUDCO. Now, HUDCO reported pretty strong loan growth in the first quarter. The company's urban infra segment did fairly well. There was some pressure on margins, however. So we're going to be discussing all of this and more with Mr. Sanjay Kulshrestha, Chairman and Managing Director of HUDCO. Sir, great to have you back with us. You know, we're going to be focusing on 3 points, and I just want to lay them out for our viewers. Let's quickly get to it. First of all, we have to understand if Mr. Kulshrestha wants to increase his guidance, because in terms of AUM growth, the company has been doing phenomenally well. Then we'll talk about the margin pressure and what happens, I mean, whether it gets better from here on. And finally, we'll talk about the ROA expectations from HUDCO that shareholders can perhaps have. Mr. Kulshrestha, great to have you on. So let's start with the good first. And that is the way your AUM is growing, right? I remember when we spoke earlier, a couple of weeks back, you had said that you will be crossing, I think, 1.35 lakh crores. Yeah, that's what you said, that you will be probably doing that in the third quarter. But since you've started the year on such a strong note, aren't you planning to revise that guidance? By the end of FY26, where will your loan book be?
Definitely, I think you are right. We need to redefine our targets, and we are working on that. HUDCO is a very sector-agnostic company wherein we can fund starting from the basic infrastructure of water, drains, or energy, or waste management. And on the onward side, if you see, we can fund port, airport, new towns, and there are lot of infrastructure which is planned by the state governments. So this is definitely giving a good tailwind to the HUDCO, and this is the result of that thing only. So we will be revisiting our guidance because I know that with this kind of pace and with this kind of opportunity, it is required that we should revive our 1.5 lakh crores FY26 guidance. And I think we will be completing this target in Q3 only.
So, sir, by when will you have a new guidance? And even if you can't share an exact number with us, I mean, ballpark, will you have 15% loan book growth this year? Could it be better than that? And by when will you have a new number? 1.5 going to whatever it is, 1.7, 1.8 lakh crores?
We are planning to come out with the number in Q3 because things will be more clearer by then, because finally these sanctions has to be converted into disbursement. You may have seen that our sanction has grown from FY23 25,000 to last year it was around 1.27 lakh crores. So these sanctions, since these are very capital intensive projects and with a construction period of 3 to 4 years time, so we are still taking the inputs from the sites and the fields. And definitely we will be reviving this number in Q3.
Okay. All right, Mr. Kulshrestha, so that's on the top line front, and that's not a concern at all. Now let's talk about margins, because margins, I mean, your guidance has been that margins will be well over 3% this year, but there was pressure in the first quarter. Is that a short-term sort of phenomena? Just tell us how your cost of funds is moving, and what you can expect on the yield side as well. Which are some of the more margin accretive projects that you're planning to lend to this year?
I think you are right. It was a temporary phenomena of quarter one. Most of our disbursement has gone on a last part of the quarter one. That's why this ROA or the margins are looking at the squeeze. But definitely this will be a lot of improvement will come in quarter two and quarter three, and we will be stabilizing by quarter two. All these assets which we had funded, all this disbursement will be converted into the bottom line. So definitely these numbers will increase and improve. So I have no doubt about that. Yeah.
Okay. All right. Hi, Mr. Kulshrestha. Good to see you. So a couple of quick... Good morning. Couple of quick questions then. There's a DAM Capital note. They've initiated coverage on the stock. They have a buy rating, target price of 280. They are citing valuations. They're saying you're trading at 10 times, some of your peers are at mid-teens. That said, I just want to clear out a couple of points because they're positive biases because of a couple of aspects. They're talking about 50,000 crores of disbursements in this year, which will ensure 30% loan growth in FY26. Possible, right?
Possible. Yes, definitely.
Okay, all right. And for the next few years, 25% AUM growth is doable?
It's doable because if you see the opportunities and the wide aspects of the company which is funding, and if you see a lot of states has came out with their own investment policy by 2030 30. The CRISIL intelligence report has revised the targets, and now, which was around 59 lakh crores, 59 lakh crores during FY19 to 24. Now they had revised to 1.6. So definitely there are a lot of opportunities and there will be upside. So 25% of the growth is catchable to support the sectors.
Okay. You're saying 25% growth of the loan book is possible, and that's a big number. I think shareholders will like that clarity. Just to go back to the margin point, sir, while you said margins will improve, do you retain that guidance? I think you're talking about almost 3.2 to even maybe 3.3% by the time this year ends. Are you still?
Yeah, we are definitely on that number. It will be between 3.2 to 3.3. So we are working on that. And if you see, during quarter 1, we had raised around 20,000 crores and our average cost was only 6.32. And with this S&P upgrading our markets, our sovereign rating, I am definitely sure that it will transfer into the external commercial borrowing rate reductions. And we are expecting some good news from the RBI. And with the CRR change also, we are expecting that the markets will reduce some rates from the banker side because of the higher liquidity. So definitely we are working on these kind of margins only. So I have no doubt that we will retain these kind of guidance like NIM around 3.2 and the spread of between 2 to 2.2.
Okay, all right. Sir, I wanted to ask you about your return ratios. The ROA is around 2%. You have been guiding that it goes back up to around 2.2%. So tell us what are the levels you have in store? And just referring to the note that I was looking at, they are working with ROEs of around 15 to around 17%. That as well is doable?
Yeah, it's doable. If you see ROA, we will be from last 2 years, we are maintaining around more than 2.2%. So now we will be consolidating at around 2.2%. And I think this quarter 1 will be the exception, and because of the disbursement and the last minute disbursement. And if you see, our loan book is continuously increasing, and this loan book is actually the increase in the loan book is reducing our ROA. But we are prioritizing increase in the loan book over ROA because finally we will get the ROA in quarters to come. But the increase in the loan book is our primary and the priority kind of thing.
By the way, we've got confirmation on that Apollo trade. This is the promoter group that has sold down a small part of their equity. It's about 1.3% stake sale that's happened. And now the promoter shareholding in Apollo Hospitals is 28%. And the sale proceeds are going to be utilized to pare down the debt of the promoter group, which also means that there's going to be a significant reduction in pledges on promoter shares. So that's the explanation, and you're seeing that play out on the stock. And as was, perhaps you can say, it was kind of expected as well. The dip has gotten bought into, and the promoters have already given the clarification as well as to why they have chosen to sell this small bit of equity. Apollo Hospitals in news today. Mr. Kulshrestha, before we let you go and before we wind up the conversation today, sir, a slightly more medium-term picture. And we know that the pivot is happening. HUDCO is now a large urban financier. And you've stated in the past that you want almost 75% of your loan book to be coming in from the urban infra space. By when will this pivot be complete? What's the breakup of your loan book right now? And say 2 years down the line, what would the mix be? And as you keep moving towards urban infra, what happens to the margin profile? Should we expect it to improve? I mean, I'm not just talking about this year's 3.3%. But as your strategic shift is completed, how will the margins look?
Post accreditation by the RBI to become a IFC, we had changed a lot of things. We had changed the paradigm that HUDCO is no more a housing finance company, and now we are working towards the entire gamut of the infrastructure. So in housing, earlier you may be knowing that we were only doing the PMAY counterpart funding to the state government, which is required, and which was going at a very lower rates with very competitive rates to support that sector of the affordable housing to the states. So now, since we are diversifying towards the infrastructure, definitely our margins will improve from the infrastructure returns. So that is point number 1. Regarding the housing portfolio, if you see, the PMAY 2.0 has already been launched, and around the 7 to 8 lakh households are approved by the ministry, our ministry, and another demand of 50 lakh houses is already with them. So in case states comes to us with any counterpart funding, which we are looking at maybe in Q3 to Q4, such kind of demands will increase. Then only it will be sanctioned. But in years to come, I think definitely most of our share will go towards the infrastructure. Presently, we are at around 68%, and by FY26 completion, we are planning that we should achieve this 75% of the mark.
Okay, so 75% of the book is going to be on the infrastructure side. The residual would be on housing. Got that point. Thank you very much, sir. Good conversation. Thanks for joining in today. Well, we do have to take a very quick break. Come back on the other side, and we will have the management of Healthcare Global joining in to talk about the outlook for the current year, as well as to understand why private hospitals are opposing General Insurance Council's common impanelment, citing pricing and claim issues.